So it's kind of exciting because there's opportunities that are here. And those opportunities aren't for me to make $100 today. Those opportunities might be to make $20,000. They might be to make $500. I don't know, and I don't particularly care. What I care is about the opportunity, the reality of it, and the tradability of it. The fact that can we get all of this together and be able to say not only is this specific date in the future going to be at substantially lower prices, but is there a way for us to trade this while managing reasonable static risk? There's two kinds of risk. Most people only think of one of them because most people only think about money when they're trading the markets. And the static risk is the amount of strict dollars that you would be losing if the trade were correct. That's the least important risk. Even though to ordinary people that would be the most important, it isn't to anybody who's more sophisticated, to be blunt. The more important risk is the likelihood of your being correct about the move that you're forecasting. That's the real risk when you're in the markets, is what's the likelihood that you're correct? If you can be right, that solves most of the other problems that you may have with static risk. And static risk takes on a different dimension when you are no longer focusing on static risk as the only risk. If somebody says, here's a trade, and if we're right, you'll make $500, and if we're wrong, you'll lose $300. You know that your static risk is $300. And if you haven't moved up Trader's Mountain a little bit, that's all you're going to think about is I might lose $300 or I might make $500. That's what's on your mind. But what could be on your mind is the following. Excuse me, but what is the likelihood that this trade is going to be correct? And a really bad answer to that question would be, well, 76% of all of our trades are correct. That's the worst answer because it doesn't address this trade. It only addresses that in the past, 76% of these trades have been correct. So people will take that and swallow it whole. Well, okay, great. I have a 76% chance. No, you don't have a 76% chance. That only refers to what the market did in the past. And the market isn't going to repeat what it does in the past. And that means it's not going to repeat its behavior, its pattern, or its statistics. So what it is going to do, and the much better way to get an answer to that question, here's what I'm trying to say, to get a better answer to the question of what is the likelihood that this trade is correct? And that is the only question that you should ever be asking about your own trading or others' trading, is what's the likelihood that you're going to be correct? And that the likelihood is going to be based on that person's knowledge of the precise set of conditions that are occurring this time in the market. It has nothing to do with the past. It has to do with what he understands about this particular set of conditions. When he trades again 2 days from now, he's going to have a different set of conditions again that he will have to solve in order correctly in order to be able to be in a position that he has a high likelihood of being correct. That's the real risk in the market, not a silly fixed static dollar amount. Anybody can say, I mean, that's like going to the tables. I either win 500 or I lose 300, but nobody knows what's going to happen. The real risk in trading is how likely are you to be able to know what is likely going to happen. That's the real risk. So the two kinds of risk are static, just referring to your fixed dollar amount, whatever it is. And the other risk is the real one, which is your likelihood of being correct about the trade. That's what we're focusing on. And on an individual trade, the static risk is going to be different each time, but it's the least important because the main risk is whether or not you're going to be correct. And that's what we're focusing on, is to how to be correct. And then once we are correct and we say, well we believe we're going to be correct, it's because we're not talking about after the fact, we're talking about before it, then we have to put a trade together and try to buy or sell the market at some place where it's likely going to reverse or is likely going to accelerate in the direction that the bigger picture is telling us the market's going to go. And I've said this before, and I'll say it again, anybody is capable of moving beyond the mere static risk concept. I make 500 or I lose 300, or I make 300, excuse me, or I lose 300 and I make 500. If I'm wrong, I lose. If I'm right, I make 500. Anybody can move beyond that, but in order to move beyond that, you're going to have some specialized knowledge. It's a fact that you will have to have some specialized knowledge. You can do this by throwing it up and saying, I'm just going to see what happens, and you might be right a few times. That's not specialized knowledge. That's ignorance hoping to be correct. You can do better than being ignorant and hoping to be correct. You can actually go beyond hoping at all and do your best work, lay it out, and say, to my best understanding, the next thing the market's going to do is go down, as an example, into the week of September 13th. That's my best work. And I'm going to try to trade that. I'm not even going to hope. I've done the work. Hope is not even part of it anymore. It's just everything I know tells me this is going to happen. And now I'm going to go in and try to put a trade together at some point and make that happen. That's the way I would hope that you get to, or the point. It's not that far from where you are in reality, but it is impossible to get to that point without some specialized knowledge. And by specialized knowledge, I don't mean that the blue line crosses the red line and then you buy. I mean something a little more involved than that, but anybody could do it, and everybody, I believe, should take that course, that path, which leads you to the ability to say, hey, I'm pretty sure we've got this right. My real risk in the market has been mitigated with knowledge. And that's what happens, is you can mitigate risk with knowledge. You can never eliminate risk, or I would never say never, because the universe is too big and contains too many things for anybody to say anything absolute. Anybody who makes absolute statements about the nature of the universe is probably making a mistake. And I say that because the universe is so deep and so manifestly different on all different levels that there's many, many different ways to skin a cat. And what might be seemingly absolute on one level, there's doorways through it on another level. So my point, though, broadly speaking, is that the risk portion of the trading is really taken care of by your knowledge. Just like an airline pilot, if he's been flying for a long time and has a great deal of experience, he's going to mitigate risk better than somebody who has less knowledge. And it doesn't mean that he won't have risk that he's unable to overcome, because something like that could happen. But he's going to cover a lot more ground. He's going to mitigate a lot more risk by having that knowledge.